Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1601A, and today's date is June 26th, 2018, and the title of the episode is The Fight to the End. Tariffs won't crash world economy. Monetary policy will. Let's get into the economic collapse financial news. Now, out in the UK, we see that the UK is about to leave the EU. The Speaker of the UK Parliament's House of Commons chamber has announced that the EU withdrawal bill that has undergone hundreds of hours of debate, well, it has been signed into law by pretty much the lawmakers. And he went on to say that I have to notify the House in accordance with the Royal Assent Act of 1967 that Her Majesty has signified her royal assent to the following acts: European Union Withdrawal Act 2018. Commons Speaker John Bercow told lawmakers during a session of the House. The UK Prime Minister Theresa May called the moment historic. Now, the EU withdrawal bill enables the implementation of Britain's exit from the European Union by repealing the European Communities Act of 1972. And this is the source of the European Union law in the UK. Legislation made by EU institutions won't affect the UK anymore, with the majority of existing EU laws becoming domestic UK laws now. The document also upholds the Brexit day in British law as of March 29, 2019 at 11 p.m., defined by the end of the 2-year Article 50 withdrawal process. So it looks like the UK is prepared and ready to remove itself from the EU. And I believe that other countries now are going to jump on board with this, especially with the immigration problems and everything else. I think there's going to be many other European countries that say, you know something, maybe it's time for us to leave the EU. Now, here in the United States, we see that consumer confidence, well, it disappointed in June. We see that expectations were around 128, came in around 126.4. And those people that were looking to purchase autos, major appliances, well, the hope of purchasing those type of items, that kind of tumbled. But what's very interesting is that we see the highest income Americans, they're losing confidence in the system. And the lower income Americans, they're seeing confidence now soar. So we're seeing the opposite effect right now, because maybe these individuals who aren't making that much, they believe in the future things are going to get a lot better. And those people that are taking advantage of the system right now, they're looking at it going, okay, time's up and everything's about to change. We see that everything's about to change with Toys R Us. In 3 days, the last Toys R Us store will completely disappear. And this is not the only brick and mortar store. And remember, Toys R Us already had an online presence too. They had both. But we can see that this is really hitting hard, and it's affecting a lot of these retailers because the economy has been doing well for a very long time. It's been getting worse. A lot of stores have been closing. The corporate offices have been closing, and a lot of people have been losing their jobs. Actually, if we look at Toys R Us, 33,000 employees. When everything's all said and done and everything's done, they will all be out of a job. Think about the rest of the retailers, not just thinking of the stores and the part-time workers. Think about all the full-time corporate employees that work for these organizations. They're all going to have to start looking for jobs. And again, if retail is continually declining, where are they finding these jobs? And this has been the same argument that we've had for a very long time. No, they're not all going to Amazon, because Amazon is a very small percentage of the entire retail industry. We see that U.S. home prices, well, the growth is starting to slow. Now, we saw this happen back in 2006, 2007, where housing prices, they hit a peak, and it was the top of the bubble, and then they started coming down. Not everywhere. In certain areas, this started to happen. I'll give you an example. In New York, prices started to come down very slowly. Traffic started to dry up. But in Miami, in Florida, they were still building. Speculators were still coming in. This was back in 2006, 2007. But when it hit right after 2008, it hit hard in Florida. So what we're seeing right now is that all of a sudden, home prices, and remember, the bubble was inflated above the 2008 housing bubble. And now we're starting to see home prices come down, which means traffic is going to dry up. Individuals are going to have a tougher time selling their houses. And as they have a tougher time selling their houses, people are going to lose confidence. Remember, confidence is built up when you believe you have all this equity in your home. You feel good. You feel comfortable. When it starts to deflate, when the prices start to come down, people lose that feeling and they feel like they're losing their money. So they tighten up. They don't go out and they don't go out and spend like they did. They don't take equity lines of credit out on their homes. Refinancing is going to die. And we're starting to see home prices fall in New York, San Francisco, Washington, and many other cities. And these are all the Case-Shiller 20-city composite where they look at these cities and say, oh, look, housing is doing fantastically. Again, the central bank was able to pump the bubbles up in these areas, and now it is deflating. We see right now there's a conflicting story right now because Steve Mnuchin, who's the Secretary of the Treasury, came out and put out a Twitter message that the White House was considering limiting investment in the United States from all countries that were trying to steal U.S. technology. And Trump is saying that, no, we had no plans to limit Chinese investment in U.S. companies. I don't know why Mnuchin was out there putting this message out there. Now, this happened once before where Mnuchin was out there telling the world something completely different that was going on. Actually, that Trump was going to be, looking at the TPP and most likely reinstating the TPP, which never happened. And once again, Mnuchin is out there tweeting on behalf of Trump. And I think basically what Trump is doing right now is kind of setting him up to take the fall later on. And remember, Mnuchin is a Goldman Sachs boy, and I don't believe he's a good guy right now. I think he's on the bad side, just like certain other people that were in the administration, like McMaster's. I think Bolton is on that same side with McMaster's. But again, Trump is keeping them in there to keep an eye on all these individuals. We keep hearing that trade tariffs are going to crash the world economy. And we need to take a closer look at this and see what is going on here. Remember, we have two sides fighting this out. We understand that the central banks, they're raising the rates. They're tightening right now because what they did was they created this gigantic illusion where they have all this toxic stuff on their books from real estate and everything else, and they're trying to get rid of it right now. They're raising rates right now to start the collapse of the system. And again, Powell was out there once again saying that, yes, he's getting ready to pop the bubbles. We know that the biz is trying to separate themselves from the insolvent banking system. And right now, we have this war where the corporate media is saying that all these tariffs, well, it's going to crash the world economy. But the thing is, tariffs are not going to do this. Monetary policy will. Who's in control of the monetary policy? That is the central bank. Now, The Economist magazine put out this statement. Rising tariffs are the worst of many threats to the world economy because, among other things, tariffs temporarily push up inflation, making it harder for central banks to cushion the blow. Now, this statement displays a deeply entrenched confusion, if not utter misunderstanding, of some of the basic economic concepts. Most important, many people fail to correctly distinguish between the causes and effects of price inflation and those of monetary inflation. Monetary inflation is the increase in the quantity of money in the economy. This inflation causes the purchasing power of money to fall, which brings about price effects, a general rise in prices of goods and services, which we can refer to as price inflation. However, this general rise in prices following monetary inflation is disproportionate and staggered. Prices will rise at different times and to different extent as money reaches a lower purchasing power. But monetary inflation also has a non-price effect. One of these is the transfer of wealth between the last receiver of the new money toward the first receiver. Another and even more important is the distortion of the pattern of investment and production. As the new money being created through credit expansion reaches stock markets and businesses, thus artificially reducing the interest rate, this latter effect explains the occurrence of production booms misaligned with consumer preferences. And if we just look at the last part of this, what happens is we have an economic bust or crash because it's misaligned with consumer preferences. These price and non-price effects of monetary inflation are general and underline every possible economic activity. Trade tariffs, on the other hand, affect only some markets and bring about increases in some prices in the economy. As this happens, our consumption patterns change. If we consume fewer imports, prices of domestic substitutes will rise. If our consumption of imports rises or does not change, we will have a reduced income to spend on other goods, whose prices will now fall. Whatever the result, it does not engender a general rise in prices or a depreciation of the currency as a result. Moreover, even if tariffs were applied to every good and service, there would be no systemic intertemporal distortion of the structure of production. A stalling of productive activity and a rise in production costs is likely to occur as capital goods, example like steel or aluminum, will now be more expensive, but capital is not underutilized, not squandered. There may be less investment, but no malinvestment. So understanding this, it is easier to see than the trade tariffs, as bad as they are, cannot produce an economic bust in the same sense as it occurs in the business cycle. The worst thing by far for world economy of interconnected financial and capital markets is monetary inflation and credit expansion. Controlled by who? The central bank. It is never a cure and always a curse. Trade tariffs are, however, the second worst threat to a global market. But once again, monetary policy will bring it down. And we can see that there is a push right now to align the United States with what is going to happen after the system comes down. So there is a battle right now, and this is why the corporate media is out there saying all these tariffs are going to destroy the world economy. No, what they're saying is that the tariffs are going to destroy the central banking globalist economy. It's very, very different, because what is being replaced with all of that is bilateral trades and a whole new system of trade. And this is why this is being pushed so hard. And again, to get to that point, we're going to go through bumpy roads. It's going to be very difficult in certain instances. And the corporate media, the central banks, they're going to tell you how bad it is. Just like with the Brexit, the entire system is going to implode if you leave the EU. If you leave the central banking system, your country will not be able to operate. It's all false narratives. They're saying all of this because they don't want the change. And what we're seeing right now is they're going to continually throw all this out and tell you how bad it's going to be, that this is going to crash the world economy. Once again, it's the central bank that is the main problem. It's their system that is the main problem. It's designed to crash. It was never designed to go this long. Usually 40, 45 years, that's it. And it breaks down, just like we're seeing. The value of the dollar decreases. There's too much debt. The whole thing just implodes. And that's what we're seeing right now. And this is why Russia, China, and the rest of the countries, they've been taking advantage of these very, very low gold prices, silver prices, and they've been adding more and more gold to their coffers. Why? Because they understand it's an insurance policy. They realize when the dollar collapses eventually, they have gold to back up what they have. And again, from all this manipulation, they know the price of gold is going to skyrocket and it's going to be repriced. I mean, think about the Great Depression, where the government came out and said, listen, we'll pay you $20 an ounce if you turn in your gold. And people turned in their gold. They got, $20 for every ounce. And they're like, ooh, look at this paper money. And as soon as they did this, they repriced the gold to $35 an ounce. The people lost out because now the gold is worth more. The same thing's going to happen here. When the system dies, the gold is going to be repriced and it's going to shoot up because it's been manipulated this entire time. So we're going to be going through this transition. It's going to get a lot worse, and we're going to hear a lot of cries of how Trump and the patriots are destroying the economy. But what he's really doing and what they're really doing is destroying their system, the globalists, the central banking system, a little bit at a time, and they don't like this. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.